Welcome everyone to Webinar Wednesdays. I'm Bill Bronchick, your host, and this week we're going to be talking about hard money lending. That is, how to become a hard money lender, the 101 version. I'm going to give a nice overview of the things you should be doing to protect yourself and your investment, and how to analyze a potential lending opportunity and where to get the money and how to document it and paper it and make sure that you get paid. Very important that you get paid, because a lot of hard money lenders who are beginners end up with a foreclosure or a bankruptcy foreclosure or something even worse, something protracted where they don't get their money back, spend thousands in attorney's fees and months, sometimes years waiting to get paid back. So follow my advice, learn as much as you can, and learn even more as you go embark onto this venture. Also keep in mind, if you're in the market to borrow hard money, this will give you an idea what hard money lenders are impressed by and how to get money from them from the opposite side of the coin. Why hard money lending? Well, a lot of people are attracted to it because it presents a high rate of return on your money for a relatively passive investment. I don't say completely passive, because you have to do some due diligence on your lending. You don't just lend out money and automate it like Rocket Mortgage or something like that and have no eyeballs on it. As we're going to discuss, you have to do some work and some due diligence. Once you get that going, it will produce mostly passive income. There's no FICA tax on interest income, which is very nice. So it's not like flipping houses or wholesaling houses where you could be potentially subject to FICA tax on your earnings. And it is fairly low risk, that is, if you follow the rules that I'm going to lay out for you today. If you don't, then it could become fairly high risk. Some of the negatives of hard money lender, well, it takes time to find customers and it takes work. So putting your money in the stock market or a CD or something like that won't earn you as high rate of return, but it's relatively simple. Click to trade. Hard money lending involves customers. You have to find customers to lend to, so you have to get the word out. It's hard to keep your money working 24/7. It would be great if you got a consistent 12, 14, 15, 17% per annum that was just continually coming in passively and you didn't have to work for customers. But unfortunately, your customer's only going to need the money if it's a fix and flip for maybe 6 months. It requires a decent amount of due diligence, and actually I wrote lots, and I'd say in the beginning especially, it's going to take a lot of due diligence before you get in the groove. Could end up with a default, and some people lend with that in mind. If you lend at 50% loan to value and your borrower defaults and you foreclose the property, you get the property for 50 cents on the dollar plus the attorney's fees to foreclose it. Now, that may be a good or bad thing depending on how your borrower left the property. If they left it a mess, if they started doing work improperly, so it actually went down in value after you lent the money, that could be a bad thing. So don't lend like that in what I call predatory lending. Lend to get a rate of return and help people out. And there also is a lot of paperwork involved that you have to become familiar with in order to protect yourself. Now, where are you going to get the money for lending? Cash, it's the obvious one. If you have a pile of cash and you want to get it moving and working and earning a rate of return, then that's what you're going to be wanting to doing is piling up cash. If you have a home equity line of credit that you could draw on at a 3 or 4% rate and lend it out at a 12% rate, then you can earn a nice spread on your money there. You could sell assets that are low performing. If you've got some real estate that's earning you, let's say you own free and clear real estate that's a 4 or 5 cap, and you can lend it out at 10% or 12% or better plus points, earning an APR of closer to 15 to 17%, that could be very profitable for you. You can refi some equity you have in properties. So instead of selling your properties and paying capital gains tax, if you have a lot of equity and a low basis, you could refinance properties, and refinance rates are in the 4% range, and take that cash and lend it out at a higher rate. You can borrow from your work 401k. A lot of people don't realize this, but you can borrow up to $50,000 normally from your 401k. Now with the COVID Act, you can borrow up to $100,000 and from your 401k or IRA and have 3 years to pay it back. And you can also lend with a self-directed IRA, either by borrowing out under the CARES Act 100 grand, and which your interest earnings would be taxable, or you can just lend directly from your self-directed IRA. That is, the IRA is the lender and is earning the interest for you tax-free. Now, here's some loans you want to avoid right off the top. Don't lend to someone who's living in the property as their principal residence. That's not a commercial loan. We're involved in commercial lending. The rules in commercial and what I call consumer lending or consumer purposes is very tricky, very regulated, varies widely from state to state, and also you have the federal rules about what you can and can't do. So I would completely stay away from that. Don't even lend against a property that's a fix and flip or a rental and then cross-collateralize it with a lien against their personal residence. You do not want to touch anything that's a consumer loan or involves a lien against their principal residence. You get into all kinds of rules and regulations. When we're in commercial lending, on the other hand, which is non-consumer, non-residential, even though might be a single-family house, it's considered non-residential lending. It's considered commercial lending for the purposes of regulation, and there's very, very, very little regulation on the federal side. In some states, there's some regulation. So, for example, in California, you have to have a real estate broker's license to broker hard money loans. Some states, you have to be a registered supervised lender to do it, but very few. Try to avoid loans for operating capital. So if you've got an investor who says, I got a house worth 200, it's free and clear, but I need some money for a while for operating capital. Can you lend me 125 or 150 against it? I'll be good for it. I'll pay it back. That's very, very risky. I'd rather see you lend against a property that has an out, that is a resale or a refi in the near future, rather than just lending for operating capital of the borrower. Or don't lending against old condos or townhomes. Not all, but you have to make sure that that condo or townhome is what's called merchantable for lending purposes. That is does it have a sufficient financial backing, a reserve? Is it fiscally sound? And most importantly, what is the ratio of owner occupants to renters in that development? If it isn't merchantable, that means Fannie, Freddie, or FHA may not lend against it. So if the plan was to fix and flip it to a buyer who's going to go get a loan, and the investor who borrowed money from you is too dumb to know the difference or too ignorant to know the difference, then it could be very risky for you, because how are you going to get paid back when the property can't be sold to anybody but a cash buyer? And by the way, for merchantability for HUD loans, for FHA loans, you can go to HUD.gov and look up the name, or by zip code, you can tell whether the particular condo or townhome development is merchantable for FHA loans. And pretty much don't lend on anything you wouldn't want to own. Something industrial, or a tire repair place that might have environmental issues, or a oil change place. Just try to keep your lending to simple homes that you wouldn't mind owning if you had to foreclose. Now, doing your due diligence as a hard money lender is threefold. You want to do your due diligence on the person you're lending to, the property you're lending against, and the deal that has been proposed by the borrower. And all three of these have to check out. You can't skip any one of these. Just because you know the person, that's great. Just because you know the property and it's a good property, that's great too. But all three have to make sense. It has to be a sensible deal that has an out plan, a strategy to get you paid back within a reasonable period of time that is fairly certain. And hopefully the borrower has a backup plan if that doesn't work. So let's look at the person. What education and experience do they have in doing what they're doing in real estate, and not just real estate generally, but fixing and flipping this particular type of property that you're lending against? Are they reasonably intelligent? Do they understand what they're getting into? Are you going to pull a credit report? Just because you know someone from around the real estate club doesn't mean that you know them that well. So you may want to pull a credit report on them. Even though you're not basing it on credit, you want to see what kind of person that they are. Are they, in hock up to their ears? Are they behind on payments on their utility bills and their cable bill, and this is their last ditch attempt to make money? So, be careful about that. Maybe a financial statement you want them to fill out. Do they have skin in the game? A lot of lenders are leery about lending to someone they've never lent to before, and will ask that the first deal or two that the borrower investor put some money up of their own. And that's a reasonable, request if you're going to do that. Are they doing other projects? Hard money lenders talk to each other often, so don't lie if you're a borrower and go to one hard money lender for one property and they say no more loans until this one's paid off, and then you go to another hard money lender. They do talk to each other, especially in smaller cities, they tend to know each other. So find out and ask them and do a little due diligence. Are they doing other projects? Do you want to get involved in a loan where it's their fourth project and maybe they're in a little bit over their head? And most importantly, is their plan based on them doing the physical work, the physical labor? And if it is, you should be worried, because what if they get injured? What if they do it wrong? What if they don't have the experience to do it? What if they get in over their head? Is there enough room in the deal for them to go hire a contractor to finish the job and do it right, pull permits and so forth? So if they're doing some of the work, make sure that they are qualified for it, that they are pulling the appropriate permits, and they are able to pull those permits for that work. The property. You want to take a look at the purchase contract and any addenda that they may have signed. What is the ARV? Don't just rely on the borrower's version. You may want to get an appraisal and or do your own due diligence. So just because they bring you realtor comps doesn't mean that's accurate. It could be skewed, slanted, or just flat out wrong. I would talk to an appraiser, maybe make the borrower pay for an appraisal just to cover yourself in the beginning. If you know how to do comps, you're a realtor, maybe do your own comps. If you're not, and you don't have that experience, maybe talk to a couple of realtors that are in the neighborhood, that work the neighborhood, and get an idea of the after repaired value and whether it's in line with what the borrower is presuming. Make sure we're going to do a title search and get a title commitment. And you want to make sure that at closing, not only do they get a title policy as an owner, but a lender's title policy that ensures title for you as the lender to make sure that you're in first lien position. Now, let me talk about that for a minute. What if someone comes to you and says, I already have a hard money loan, I'm over budget, I need to borrow money, and you'll be in second position? That can be very risky. Now, I'm not saying never do it. I'm just saying it depends on how much work is left to be done, how much equity is left in the deal, and how much loan to value the first mortgage is. So if the first mortgage is at 50 cents on the dollar, 50% LTV, and the borrower, just got in over their head and they ran out of cash, and they did put up a decent amount of money of their own, and there's enough equity to put another, 15 or 20% lien on the property, you might just do it and charge either a higher interest rate, more points, and or maybe a piece of the profit. But I wouldn't do that as a beginner. Should you get an inspection? Well, hopefully the borrower got an inspection and shows that to you. But if they didn't, then you should order one at their expense and make sure they do an engineering review of that inspection. Not because, in most states, property inspectors aren't really licensed or regulated, so anybody could be a property inspector after a 10-day course. Make sure it's someone with an engineering background that can give an opinion on the foundation, because if you take it back, do you want a $40,000 foundation problem that you didn't know about? And a sewer scope as well, if there's any trees especially, or it's an older house. Visit the property. I can tell you from personal experience, visit the property yourself and get your eyeballs on it, kick the tires. I only got burnt once as a hard money lender, lending money out, and it was because I didn't visit the property. And I relied on an appraisal, an inspection, pictures, broker's opinions, blah, blah, blah. I didn't walk the property. And after it defaulted, I realized that the block behind it was lined up with commercial, oil change, car repair, bad stuff. So that type of information you can't really get from an appraisal. You get it from walking the property. A survey or an improvement location certificate, which is like a short form survey. This isn't always required unless the property is on a short lot line that is old. So in the city of Denver, we have old properties that were 100 plus years old, short lot lines with fences and garages that right up to the property line. So a survey will tell you if there's any encroachments either on one property or from theirs to yours. So it's important to know, because if you don't know the lot lines and someone is rebuilding, say, a garage that's over the line, and then the neighbor says, get it off my property or I'll sue you, removing a two-car garage from the equation could change the value of your collateral substantially. And if there's any commercial things in the area, that would include gas stations, oil change, dry cleaners, or any kind of chemical, anything within the block. You may want to insist on a phase 1 environmental inspection to make sure that there's no spill off onto the property that might cause an environmental liability that you as a lender would inherit if you foreclose the property. Okay? And by the way, these lists I'm giving you are not exclusive. They're just some bullet points to consider if you don't know what you're doing. Let's look at the deal. Why is the deal important? Well, if the goal is to get paid back with interest timely, we want to make sure that the deal makes sense to us. Now, if you're not an experienced investor, you may have to have someone else do the due diligence for you. But if you have some experience as an investor and the person you're lending to does not, then you want to make sure that they know what they're doing. Does the deal make sense? Have the borrower detail the numbers in writing. So if they say, look, I'm buying it for X and the repairs are Y, I want to see the repairs as a lender. I want to see a detailed bid from his contractor of what he thinks is going to cost $45,000. It may be wrong. It may cost him $65,000, or he might have a bad contract with the contractor, or he may not even hire the contractor and plans on doing it himself, and he's just way off on the numbers. What's the borrower's exit strategy? Well, typically on a fix and flip loan is to fix and flip. But what if it can't sell? Is the borrower willing to break even or even reach into his pocket and lose money and sell the property at a loss? I mean, you need to get that straight up front that, listen, I intend to get paid back. And, the buyers on the market don't really care what you're into it for. They want to pay what the market will bear. And if you're into it with repairs for more than you expected, that's your problem, not mine and not your buyer. Have they been turned down by any other lenders? People tend to shop and they get turned down, they go to another one, turned down, they go to another. By the way, if you're the investor and you've been turned down by 3 or 4 hard money lenders, it should tell you something about your deal. It probably isn't that good and you're missing something. Now, sometimes it's a weird thing, like it's a lender says, we don't lend on condos, or we don't lend outside this area, or we don't lend to first-time investors. Then it's a little different. But if they've been turned down by other lenders, and you would ask them this, of course, and hopefully they'll tell you the truth. Is the deal worth the risk to the borrower? That means, are they going to put up some money and potentially lose some money, get some skin in the game? Is the loan worth the effort? Is it too small or just too short of a term? So ideally, if we're going to charge, let's say 12% interest, and let's say, 3 points up front, a point is a percentage of the loan. So on a $100,000 loan, 3 points is $3,000. And if you're charging 12% interest, 3 points means you're earning 15% per annum if you do it once a year, 18% if you do it twice a year. Okay. So assuming a 6-month term, 12% interest, 3 points, then you're making 15% over 6 months. Okay. If you did another loan and got another 3 points and 12%, then you'd be making 18% per annum. Okay. So is the loan worth the effort? So if someone asks you to lend $40,000 on a condo, you may be getting 15% per annum, but what's 15% on $50,000 anyway? Not a big number, especially if they only need it for 2 months. So you may want to have a minimum interest. You may say, look, I get 4 months of interest, whether it takes you 4 months or 6 months to sell it. So if they get it by some stroke of luck fixed and sold within 2.5 months, you still get 4 months worth of interest. Let me give you an example hard money loan deal so you get a flavor of how this works, and we'll take some questions. You just pop them in the Q&A or in the chat, and I'd be happy to answer some questions as we go. So let's say we have a single family home with an after repaired value of $250,000. The purchase price they're buying it for is a nice $150,000. Needs $35,000 in repairs, okay? The loan max LTV you want to go is 70% of ARV or $175,000. Now, why 70%? Because that's typically what you would buy it for as an investor. So the max loan is 75% of not the purchase price, but of the ARV. Now, the borrower needs cash to pay for the closing costs, the appraisal, the inspection, points on the loan, and they must have 6 months reserve funds worth of payments, right? And the $10,000 worth of the repairs. So you're not going to lend them all the $185,000. You're going to lend them the purchase price, the $150,000. They're going to have to fork out of pocket at closing, the closing costs, the appraisal, the inspection, 2 or 3 points on the loan, and they must prove they have 6 months worth of payments in reserve in their bank account. Now, they can take it out as soon as the closing's over, obviously, but you want to see if they can, show some good faith here that they could pay the loan over. You could defer payments. I've seen lenders lend money and say no payments, and then the interest will accrue, and it's all due at the end. I don't particularly like that as a lender because I won't know if they're going to default until the end of the loan, till the balloon. If they're going to make payments monthly and they default in the third payment, I'd rather know now than know at the end of 6 months when the balloon comes that they're going to default, okay? Plus, remember, we're only lending them 70% total, so they're going to have to bring another 10 grand worth of repairs out of their pocket to close. And so in this case, the borrower is not going in with no money down. Once you get to know the borrower, or if the total ARV was, loan to value based on ARV was 60%, all in with closing cost points, appraisal, inspection, everything was all in at 60%. Might I allow the borrower, once I get to know them, to do the deal with no money out of pocket? I might. Now let's look at the paperwork. You need to paper up a loan. You want to start with a loan application, first of all. The Fannie Mae 1003 is the standard loan form. It's a good one. I recommend you have them fill one out or something similar. A loan agreement, that's different from a promissory note. A loan agreement contains additional representations and promises of the borrower that if they default on would be a default on the loan as well. So the loan agreement is going to state things other than the promise to pay, like in the promissory note. And obviously we're going to have a promissory note. Should we get a personal guarantee if it's a corporate entity? If you can, I would certainly encourage you to do so. You can't if it's an IRA. IRAs are not allowed to give personal guarantees, but you may want to. A copy of their operating agreement if they're an LLC, plus a resolution that authorizes this specific loan if their operating agreement doesn't explicitly give them the authority to take loans out on behalf of the company. And I said here about guarantee from all the LLC members. So if there's 3 members of the LLC, the guy, his wife, and his brother, and he's the only one, coming to you for the loan, should you get guarantees from all 3? Hey, the more the merrier. You're going to need a security instrument, which in a mortgage state would be a mortgage. In a deed of trust state would be a deed of trust. Both are, we refer to them as mortgages, but they're both security instruments that when recorded against the property become a lien for performance of the promissory note and the loan agreement. Okay, and disclosures. You're going to have certain federal and state required disclosures, even on a commercial loan, particularly that this is not a residential loan and they promise not to live in it. And then you have to give the lender instructions for the escrow fund. So this is for 2 things. So you're going to wire money over to the title company to escrow funds and not cut funds at closing until the certain conditions are met. So you have to give the lender instructions on what you want to see, like proof of hazard insurance, premium paid, that the borrower has a resolution from their LLC, et cetera, et cetera, et cetera. Also, in the previous example where we said it was $150 for the purchase price, and then I'm lending them $25 towards the repairs, are we going to just hand over $25 grand to the borrower at closing and say, here's the money, go fix it? Probably not. Probably a bad idea. If it was 10, I'd say yeah. But if it's 20 or 30 or more, you want to have the title company or closing attorney or escrow company hold back the repair money in an escrow. As they perform work on the property in stages, then you go out and inspect that or send someone to inspect it, charge a fee for doing so because your time is worth money, and then authorize the escrow company to release chunks of money out. Don't release the chunks of money out until the work has been inspected and the contractor signs a lien waiver. Very important for the contractor to sign a lien waiver before you cut the check. And you may not even cut the check to the borrower. You may cut it directly to the contractor. So you're going to need escrow agreement with the title company or closing agent that spells this all out. Okay, so let's say you get through the loan and your borrower defaults. Communicate. They may not be talking to you, but you should be talking to them and let them know, hey, listen, it's not personal, it's just business. Talk to me. Let's see if we can work this out. Find out what the problems are. Maybe you could solve the problem. Maybe they spent some of the money they were supposed to spend on the property on personal things. Maybe their contractor ripped them off and or walked off the job, whatever it is. Maybe you can help solve their problems by providing the name of another contractor or another solution. Maybe you waive some of the default interest. Typically, a promissory note will have a stated rate of interest. Let's say it's 12%. It'll also state that in the event of default of payments, the interest rate steps up to 21% or 18% or maybe even higher. Well, if they defaulted on payment number 2 and the interest rate steps up to 21%, the interest could be accruing so fast that they're just in over their head and they're just ready to just throw up their hands and walk away. So maybe you'd say, listen, I won't charge you that default rate. I'll just charge you the 12% and we'll get you another contractor and help you out and get it through. You know, you got to try to work towards a solution here. You could extend or allow them to reinstate the loan. So you may say, okay, you're 2 weeks late on your second payment. Give me all the money by the end of the month. I'll waive the late penalty for this month. And I know it said 6-month loan. After that, it would be in default if you didn't pay it off. But, you know, since your contractor screwed you and you have to start all over again, I'll give you an extra month. Or the extra month, the interest rate goes up a little bit from 12 to 14%. So work something out with them. And make sure you check title for junior liens. This is where it gets sticky. So your loan agreement should say in it that they can't take out any more money. So they can't run out of money and run to someone else to get a second lien against the property, maybe your friend or relative. And the reason you don't want them doing that is if they do default, hopefully they will give you the property with a deed in lieu of foreclosure so you don't have to foreclose. That's cheaper, faster, and easier. And if they're honorable, they will. But if you foreclose, you wipe out any junior lien holders. But if you get a deed in lieu of foreclosure, any liens behind you will remain. So you can't do a deed in lieu if they took out a second. So check title for junior liens while you're going through this process. Okay, we have a question here. George asks, the guarantee, you can't have a personal guarantee for the IRA. Is that the IRA as lender or the IRA as borrower? That's the IRA as borrower, George. If you're lending to someone's IRA, the individual cannot give a personal guarantee. Okay. Let's talk about a punch list here I have of 10 ways to reduce your risk as a hard money lender. Number 1, stick to your rules. You should have a set of rules. I only lend 65% loan to value. I'll only lend 65% loan to value with the borrower putting up at least 10% of the money. I'll lend up to 70% if I've done 3 loans with them. I only do this with an appraisal. So have yourself a set of internal rules and don't violate them. Number two, I said this before and I'll say it again, it's so important. Always visit the property. Number three, consider using an attorney to draft you a set of documents for your loan, or maybe have them do it on every deal and just charge the borrower an attorney fee. You can do that. Use an appraisal. Unless you're really good at comps and you really know the neighborhood, get an appraisal. Also get an inspection. Get the borrower to put up some skin in the game, whatever it is. Even if it's, even if they're really broke, say, listen, you got a credit card? Go put $10,000 worth of stuff at Home Depot on your credit card in terms of materials. That way you know that they're not going to walk away so fast. Insist on using your contractors if they're inexperienced. So they may say, well, I'm going to do the work myself, or my cousin's going to do the work. If you don't know this person, you don't know their capability, and especially if they're green, insist on them using your contractor. Why? Because that contractor you can rely on. He knows what he's doing, and he's going to report back to you any misgivings of the borrower or any nonsense going on. 8, visit the project often. You're lending money, you don't take the word for it of how it's going. Drop by every few weeks, unless it's really far away, or maybe if you're using your contractor, have them give you video updates. Stick to neighborhoods you know at first. That way you don't get into a surprise. I mean, you can go into a strange neighborhood if you have an appraisal or an inspection, but there might be some things about the neighborhood that you're just not familiar with. And number 10, go with your gut instinct. If these red flags are going up and your gut is telling you this person is not going to pay, they're going to be a problem, we're going to end up in default, we're going to end up being partners, I'm going to end up with the property, your gut instinct is generally right. Now, men don't have as good a gut instinct as women do. So if your wife or girlfriend or significant other is going, I don't trust this person, for a minute you shouldn't lend to them, you're going, you're just being paranoid, listen to your wife. They're usually right. Women have very good intuition about things like this. So men, listen to your women, okay? All right, let's take some questions here. Oh, I got a clap, thank you. I got an applause. It's hard to do on a webinar, I miss the live audience, especially with people laughing at my really bad jokes, All right, we got a Q&A here. Okay, so let's say if you have an individual and they sign an affidavit at closing stated that they don't plan to occupy the property, but afterwards they move in and file a homestead exemption. Well, if you have a loan agreement and the loan agreement says if you move in, you're in violation of the loan agreement, you could threaten to call the loan due. You can't stop someone from doing something underhanded like that, but I don't think you'd be in the consumer loan category if they represented it as a fix and flip for an investment, signed an affidavit saying it's not their residence and they don't plan to live there, and then moved in. I don't think you're going to have a problem with violating any, lending regulations in the consumer arena. Okay, so if you have a question, just pop it in the Q&A or in the chat there. I wanted to tell you a little bit about getting started. So getting started, assess your resources that you have for lending, come up with a set of guidelines, come up with a set of lending forms that are appropriate for your jurisdiction, maybe have a website or an app with a loan checklist that you put on there or they can download, and get the word out. Hard money lending is competitive. That's the only downside of this. You're not the only game in town, so you got to have a unique sort of selling proposition, your USP, what's going to make you different from everybody else. CYA means call your attorney. So if you don't know what you're doing, call your attorney, make sure you're in compliance with lending regulations, that your paperwork is in order, and find out what you don't know that you don't know about hard money lending, because you don't want to learn the hard way, trust me. Some closing thoughts. You don't need a ton of money to lend. You could do seconds or you can do smaller firsts. Take the time to write out a business plan, because this is not just a passive investment. As I said earlier, can be passive in terms of the income compared to doing work on the property, but take some time to write a business plan. Become familiar with the lending regulations in your area. Start with properties in areas that you know very well, and start with people that you know well, that are experienced, that you know are not going to be screwing around and know what they're doing. My home study program, my Legal Wiz Guide to Hard Money Lending, is going to be your #1 go-to resource, as video from a live seminar I recently did, and audio files to download into MP3 on your player, phone, iPad, whatever, or burn to a CD in your car if you still have one of those. And a course manual and tons of lending forms and checklists. So I have multiple promissory notes, escrow agreements, agreements for construction draws, and I've got notes and mortgages and deeds of trust for all 50 states in there. So is it valid in all states? Yes. I mean, it works just fine, but you may want to have an attorney in your area, or consult with me afterwards, for a small fee, to see that you got the right forms in the right order in your lending package. But everything is in there that you need. It's a paltry $397. Don't be penny wise and pound foolish and download forms off the internet. It's just don't be foolish. The forms alone are worth 10 times the price. An attorney, usually myself, when I do a hard money loan set of documents for a closing, I'm going to charge $750 to $950, depending on the type of deal it is. So for $397, you're getting a pretty good set of forms. You can go to legalwiz.com/store. Hold on. Let me pop this into the chat. So look in your chat. This is a direct link to the course. And then I'm also going to type in there the word independence. And that is going to give you a 50% discount through this weekend, July 4th weekend. So put the code independence, 50% discount, and you can pick up the course. It is an electronic course, so you can get instant access to it, all the forms to download, and so on and so forth. Okay. Patrick asked me, can I get information? Can I get access to my slides? Yes, Patrick. The slides and many more are in the course. Yes. This is just like a sampling of slides that I pulled out of the course itself, that I used to do the actual course, which is probably closer to 100 slides. So the PowerPoint slides are in the course. Adriana, do you focus hard money lending, or do you do retail wholesale sales as well? Oh, Ariana, I'm sorry. Ariana, I do all kinds of real estate. I do fix and flips, wholesales, rentals, wraps, commercial, syndications, apartments I've done, mobile home parks, self-storage facilities, RV parks, all kinds of stuff, Okay. All righty. Let's see if we have any questions here left in the chat. Oh, I'm sorry. I didn't send to the attendees. My apology. The code is independence. I'll throw it in the chat there. And then the link directly to the course I put in there. But if you go to legalwiz.com and click on store, that code is good for 50% off any of my courses this weekend for July 4th weekend for Independence. So I think that's all the questions. Maybe there's one more. Let me take a look. All right. I think that's all the questions for today. Thanks, everyone, for joining for Webinar Wednesday. I'll see you on the call next week. Have a wonderful July 4th weekend. Stay safe, have fun, and make sure you cook lots of beef on the grill. And if I just offended any of you vegans out there, well, it's just too bad. Go and have a hot dog and get over it. All right. Take care, everybody, and have a great weekend.